Good afternoon, everyone, and welcome to the 4 o'clock slot, where we're joined by the managers of BlackRock Latin American Investment Trust. The good news for those of you who've been sitting here since 9 a.m. is that the next 45 minutes are going to fly by, I think. Latin America is one of the most overlooked regions in the investment space, making up just 8% of the MSCI Emerging Markets Index, but offers exciting potential for returns during strong global economic recoveries of the kind we hope is likely to occur once vaccine programs around the world begin to take off and the COVID crisis finally begins to recede. BlackRock Latin America is well placed to benefit in that environment. Between them, the managers have nearly 40 years of experience running money, and both are experts in emerging and frontier markets. Ed Kuczma joins us from New York, where he leads BlackRock's emerging markets research effort, and Sam Vecht joins us from London, where he's pod leader for EMEA, Frontier Markets in Latin America, and co-manager of the BlackRock Frontiers and Greater Europe Trust, as well as BlackRock Latin America. They've both volunteered to take questions during the presentation, rather than waiting for me to ask them on your behalf at the end, which is a very brave offer indeed, so please do take advantage of that and fire away. Over to you, Sam and Ed.
Hopefully you can hear me. Start off with the great phrase of 2020 and now 2021. So as was just highlighted, we are very keen that you ask questions all the way through the presentation. And to facilitate that, I'm going to be watching the questions come through, and Ed's going to be going through most of the presentation. I just want to start off by saying this. Latin America, as highlighted earlier, has been overlooked by lots and lots of people. Many of the markets in Latin America are multi-year lows. Everyone thinks things only go wrong in Latin America. That is wrong. That is not what we're thinking. There is a recovery going to be taking place in Latin America. The markets are cheap. They are overlooked. There are good stories in there. It's not just about problems. Ed's going to highlight some of the great opportunities there, and I'm going to facilitate the questions. Please send the questions in. The harder, the better. And as this is the end of the day, the only way we're going to keep people's attention is by people throwing in a few googlies and a few really nasty questions there. Sorry, Ed, you're probably not familiar with what a googly is. I'll explain the cricket term to you later. Ed, over to you.
All right, great. Thanks a lot, Sam. And just to give a broad introduction of what you get when you invest in BlackRock Latin America Fund and what you get in general in Latin America. And I like to characterize the region as the land of the 4 C's. And these are commodities, consumption, currencies, and credit. And these are some of the main different sectors that we invest in and take long and short positions in an effort to outperform the benchmark. First, just an overview of commodities. A couple of the commodities that we're excited about this year and positioned to take advantage of price moves include pulp and paper. We think that after a long period of subdued prices, we're starting to see improved pricing on the softwood future side. We're seeing a big restocking in demand given the restarts in China. And we're also seeing a lot of lower availability as a lot of the large producers in the region are going through maintenance downtimes. Also, the anticipation for dollar weakness also benefits not only pulp and paper, but most commodities within the region. I would also say that we're bullish on Mexican cement producers as well. And this is due to strong demand for cement and a very strong housing market in the United States. The cement producers we own straddle the border and are very close to the southern belt in the United States, be it Texas, Florida, Arizona, California. And with the low interest rates in the US, we're seeing not only new constructions coming through, but also a lot of home renovation and also potentially greater demand from infrastructure stimulus that could be coming through the United States. We also have a strong position in lithium, and we are invested in the large lithium producers in Chile, who happen to be some of the lowest cost producers in the world. And obviously there's a lot of demand for this commodity coming from the expected boom in demand and popularity of electronic vehicles. Moving on to consumption, there's a lot of exciting investments in consumption that we look to take advantage of. Specifically in Brazil, we're seeing record low interest rates and a little bit of an uptick in inflation, but well below historical levels. And this leads to greater disposable income. Also, the record low interest rates allows for consumers to take on more leverage, which allows them to buy more durable goods and higher price goods, let's say a mortgage or automobile loans for really the first time, as they've been priced out of the market on high interest rates in the past. We've been more optimistic on Chile consumption. And really, Chile is an interesting story because they've been outperforming in terms of the vaccination of their population. They currently have 22% of their target population vaccinated already, and they're on track to have the entire population vaccinated by the end of the first half of this year, if all goes well. So we think that'll lead to a resumption in consumption in Chile. And we also look to play some thematic shifts in Latin America, the so-called leapfrog effect in e-commerce. If you look at developed markets like US and the EU and in Asia, e-commerce sales as a percentage of total retail sales is close to 20%, where in a lot of countries in Latin America, this is below 5%. So we see a lot of room for e-commerce to improve the penetration and take share from your traditional brick and mortar companies. In terms of currencies, we're positive on Chile and Peru.
I'm gonna jump in here because we already
Please.
have 4 questions. And
Let's
before I go to those 4 questions, and we're going to try and keep this sort of really interactive. I'm not going to filter the questions, just to remind people of the really big picture stuff that Ed has been saying. What Latin America is about. It's about wonderful growth opportunities in things like e-commerce, the ability for these companies to sort of leapfrog what we've seen in the US, a massive runway for growth. It's about exposure to EVs, lithium, obviously critical to that, and Chile is the place to go for lithium globally. It's about infrastructure. Everyone's excited about what Biden's doing. It's about infrastructure build coming over the border. It's, various companies exposed to that, but it's also the building of infrastructure within Latin America. And it's also finally about a cyclical recovery. Everyone knows 2020 has been a bad year. It's about cyclical recovery. Those are the 4 big stories really coming out of Latin America today. So let's go to some of the questions. First question we got is, what are the implications, short, long term, of Bolsonaro's intervention in Petrobras? I'm just going to start off with that and then hand over to Ed. This is an emerging market. In emerging markets, the governments get more involved in running companies directly or indirectly than they would do in the US or the UK. So that's just one of the things we have to bear in mind. Investing in state-owned enterprises is not always a bad idea, but they always come cheaper than the private companies. So one should not be surprised about Bolsonaro getting involved in Petrobras, just like we shouldn't be surprised about AMLO getting involved in Pemex, just like we shouldn't be surprised about Putin getting involved at Gazprom. This is a global story, and the French government every so often sort of tell Total what they can do as well. So, let's be clear, this is a global story when it comes to emerging markets. And I think there may be some long-term implications I'll come back to in a second, but this is not something that really should surprise us too much. It's the way it's done and the manner in which it's done. And that actually links into a second question. Someone's asking, why is the NAV of the fund dropped over recent weeks? That really has been a function of what's been going on in Brazil. We've got a lot of exposure to Brazil, and the Brazilian market has sold off, possibly excessively because of concerns about what Bolsonaro has been doing. Over to you, Ed, before I handle a few more of the questions.
Yeah, just following up on Petrobras. I mean, if you look at global oil and gas producers, Petrobras has some of the lowest cost of production and some of the greatest amount of reserves, which should lead to higher production growth going forward. So, while we're seeing some short-term weakness, there's a lot of noise of a potential trucker strike. Obviously, Bolsonaro is stepping in and kind of appeasing to his base to keep the diesel prices under control. We think longer term, there's a very solid path of deleveraging and dividend creation for shareholders here. Maybe just moving on with the presentation here, we are, as the slide says, we are a little bit cautious on the Brazilian real. We do see it as historically cheap, but as Sam pointed out, there is a higher risk of political uncertainty. We have an election coming up in 2022 for the presidency in Brazil. Bolsonaro's approval ratings right now are around 35%, and which is relatively low, especially for an incumbent in Brazil. And we think this will invite a lot of other potential challengers into the race and also creating more uncertainty. So we've been a little bit more cautious on Brazil recently. But on the flip side, positive on Chile and Peru in terms of their currency, and that's a lot of that's based on the stronger commodity prices, especially lithium and copper. So we're optimistic there. Just moving on, and credit is another one of the 4 C's. We see Brazilian banks really supported by potential rate hikes. A lot of this currency uncertainty and a little bit of a higher inflation in Brazil should lead to a quicker and higher path for interest rates in Brazil. kind of countering the global trend, and we think that'll support the currency. In Mexico, there's a really underpenetrated use of credit, and we think that a lot of the new technologies and the digitalization of mobile wallets and cell phone banking can really have a leapfrog effect in Mexico. There's also another, in terms of the Peruvian banks, we're underweight here. That also leads to an election in April, where after that we expect to get some clarity. Just moving on to the next slide here, just to go over some top themes in the portfolio. And this is kind of what we look for to populate the portfolio as we look to outperform. We're always looking for structural growth. And these are companies which benefit from secular trends that should persist throughout the cycle. These could be underpenetrated demand stories, market share winners, and industry consolidators. Some examples of these include e-commerce, software, healthcare, convenience stores. We are also very keen to invest in what we call reinvestment opportunity leaders. These are quality companies with positive spread of return on invested capital over their weighted average cost of capital, which leads to value creation. And that presents sector market share gain prospects. Some of the names that we play in this are in the tech field, digital payments, car rental. We already touched on materials, and we are actively overweight material sector and looking specifically for stocks with attractive valuation. We are seeing a recovery in demand and tight supply coming out of the COVID pandemic, and this has definitely supported commodity prices. We expect this positive cycle to last longer. And Latin America has a lot of natural advantages as a low-cost producer in a number of commodities. The sectors we're playing, as we mentioned, are in steel, copper, pulp and paper, lithium, and cement. And then we're also have an eye towards the future with as the economies open up and the vaccinations start to get distributed. You know, who are the winners as mobility starts to improve again? These are cyclical companies offering positive and appealing asymmetries when compared to their historical multiples. So companies that are cheap, given the COVID overhang. And you know, some of these sectors that we invest in are airlines, real estate, and consumer. Sam, do we have any other questions before I go to the next slide?
For them. Perhaps take a topical one that people always ask about. How do we think about ESG in I think I've got about 8 outstanding questions. I want to take this one about ESG because it's the first thing that people ask about. How do we think about ESG when they allow burning rainforests, human rights infringements? I'll just start off by saying that clearly living in emerging markets, operating in emerging markets is not the same as operating in the developed world. The great thing about Latin America is they've got a free press, so we actually hear what's going on. So the way we interact with companies is in a very strict way in terms of ESG and encouraging them to do the right thing. Obviously, we've got BlackRock is very much focused on that. But I think sometimes Latin America gets a far worse shift than one hears about certain Asian countries where one doesn't even know what's going on. And definitely, you know, what we hear from some of the other countries is considerably less pleasant than perhaps often meets the media. But how do we think about ESG matters when it comes to Brazil? Ed.
Yeah, I mean, ESG, I think there's a lot of opportunities to improve. And one of the roles that we play as active managers from BlackRock is to really engage with the companies. And we're always looking for best-in-class procedures from the corporates we invest in on all three, the E, the S, the G. I think that the first hurdle, it's probably relatively easy. It's just improving the disclosure. I think there's a lot of companies that actually have a very strong ESG program and a good sustainability, a lot of good sustainability initiatives. It's just really conforming to best practices in the developed markets in terms of telling that story and and expanding upon that, so it gets better reflected within the ESG rankings from BlackRock internally or from our third-party providers. So I think that'll improve over time. And right now it's kind of an uphill battle with the third-party producers of the data because they don't have the resources and the amount of people to really dig into the ESG like we do. And we think it's the direction of travel that matters most. So we're looking for companies that are probably underappreciated in terms of ESG that we think will become long-term winners in the field.
And that's really important. It's the direction of travel. Obviously, it's like saying all the people in Latin America are poor. Clearly, they're poorer than we are in the US, but it's the direction of travel which is important. The other related ESG question we had was less on the environmental side. How do minority protection rights in Latin America compare to the UK or the US for that matter?
Yeah, I
Ed?
would say, it's also a region where minority protection can be improved upon. And I think, partly because of BlackRock's engagement with these companies, and we really do spend a lot of time going over, the composition of the board of directors, board diversity, getting diversity of thought on the board. We're always looking to, point out the best in class companies and invest alongside with them. I will say, historically, what the main difference is with the developed markets is that you have a lot of companies that were founded by a family or very entrepreneurial owned and managed. And there are, sometimes there are cases of abuse there. And what we look to invest in are companies that are further along on the institutionalization curve, companies that understand that if they want to really emerge as a regional leader and a global leader, that they have to incorporate best practices when it comes to minority rights. We've seen improvements specifically in Brazil in terms of companies that have reduced somewhat of a dual class shareholder structure. So you used to have preferred shares and ordinary shares, and the founders would get extraordinary voting rights. And we've seen a collapse of a lot of these share classes into one vote, one share type of a standard. And we've actually seen a lot of the multiples appreciate on companies who do that and put in the work to have the best practices. So I will say it is a work in progress. Latin America has a lot of room to improve, and we look forward to engaging with companies to facilitate that improvement.
One final point before Ed continues, and I'm conscious that we have got 5 unanswered questions, but I think it's really important we get over some of our key messages. It's very interesting for us when we see corporates not list in Brazil because of its strict listing rules and go and list in the US instead. And there's a series of companies that have been unable to list in Brazil because they've got such strict listing rules that have basically run up north, as it were, to list on Wall Street, where actually the standards are considerably lower. So the standards in Brazil for quite a lot of listing rules and requirements, which possibly are going to be relaxed now in the UK, strangely, are actually tougher, tighter, more regulated, and much better than they are in the US. And that's actually to be welcomed. Back to you, Ed, for a few slides, and then we'll do some more questions.
Okay, great. Yeah, just want to go through our overweights and underweights by country here. Mexico is one of the largest overweights we have in the portfolio. And maybe if I could just touch on one of the questions I see in the queue here, does the Biden win a net positive or negative for the region? And I think Mexico is probably one of the biggest beneficiaries of a Biden win. When Trump got elected, there was a lot of uncertainty in terms of his relationship with Mexico. You heard a lot of tweets about the U.S. moving jobs to Mexico and stealing jobs away from the Rust Belt in the U.S. And we see a lot of this negative rhetoric, whether it's immigration or jobs moving south, as not being as much of an issue with Biden. And we haven't really heard anything on his agenda at all about the relationships towards Mexico. I will say that we do invest in a couple of companies that benefit from kind of this, I would say, diversification away from China in terms of supply chains. A lot of U.S. companies prefer to have the security and safety of producing closer to home in Mexico, having a quicker just-in-time inventory system, and avoiding some of the biosecurity and intellectual property issues that you run into in China. I will also say that the cost of labor and the low-cost production in Mexico has actually been highlighted, as you've seen higher wage growth in China, and Mexico from a labor standpoint is extremely competitive. And one of the benefits of the Trump presidency was that we did have a revision of NAFTA, the North America Free Trade Agreement. Now it's the U.S., Mexico, Canada agreements. And that's a framework that we think will facilitate free trade, really benefiting Mexico manufacturing. And if you look globally, I doubt you'll find a better collection of countries that are developed in terms of infrastructure, be it highways, seaports, airports, pipelines, telecommunications, than North America. And I think if we're looking to be if the U.S. and North America, Mexico, Canada look to remain as a global powerhouse in terms of manufacturing and trade, they need to work together and really, prove that they're competitive versus the Asian counterparts. So that's part of our overweight stance in Mexico. Not only that, but Mexico usually is very geared towards the U.S. economy, whether it be remittances from Mexican Americans living in the United States and sending money back home. We think the improvement in the cycle in the U.S. will make Mexico a big beneficiary in that regards. Just moving on to some of our other overweights, Brazil, we do see a lot of bottom-up fundamental stock-specific companies that we think have very bright growth outlooks. The political interference, I think the politics in Latin America in general always provides opportunities and challenges in terms of managing the portfolio. And we look to, take advantage of this volatility, to either be overweight or underweight where we see pockets of uncertainty. But we must not lose sight of the fact that there are some extremely well-run companies that are gaining share, that are profitable in Brazil, and that provides opportunities for us from a bottom-up stock-specific basis. Chile, I went over, I think they have very positive exposure in terms of the commodities, with copper being supportive, and the vaccination there is also very supportive. Argentina has also been an area where, the politics has kind of interfered with the top-down story. But again, in bottom-up, we find attractive stocks to invest in, whether it be in commodity producers like a steel name, or say a global IT company that has a lot of business in the United States and low-cost production or low-cost labor advantage working out of Argentina. So that's more stock-specific. And I did mention our underweights here. Peru, we do have an election in April of this year. Right now, the polls, the winning candidate with 35% of the votes is the uncertain, category in terms of the polls. So the next two runners up have 11% each. So it's very uncertain, especially given we're only about a month and a half away from the election. So we're not going to really take a bet there until we have more clarity. Colombia is also an area that we're underweight. The economy is very dependent on oil. They do have a higher fiscal deficit following a lot of the stimulus that they put through the economy last year during the pandemic. And we just see a slower opportunity for that economy to recover relative to the others. Just on Sam, any other questions that we could address before we move on?
Yeah, I mean, we've got lots. I'm going to hand over to you for one about valuation, because that's sort of a slide that's coming up. I just want to tackle sort of two more of the questions that are somewhat linked. And I said, thank you very much. I think we're up to 18 questions so far. We're trying our best to address all of them. Two or three questions have basically said, Latin America's done really badly for the last decade, I think was one of the phrases. What changes that? And how do we think about sort of the medium-term outlook? And I think when it comes to being a fundamental investor, we believe there is some connection between share prices and earnings. Now, it's quite true. If you look across emerging markets over the last year, the best performing stocks have been the companies with no earnings, with bad corporate governance, and with serial capital raising. So if I'd gone to the people on this call and said, give me money for a fund that invests in bad corporate governance, profitless companies, that would have been a great strategy in 2020. As long-term investors, we don't believe that's a great strategy going forward. And I would say further, it's quite true that almost anything you could have invested in has underperformed a NASDAQ ETF over the last 10 years. Just owning a NASDAQ ETF would have had amongst the highest returns with the lowest volatility. Of course, that would have been true if you'd started in 2010 and ended in 2020. If you'd started in 2000 and ended in 2010, it would have been exactly the reverse. And we've come through a 10-year period where there's been one particular style that has won, and one particular asset class that has clearly beaten everything else. And just thinking that's the story going forward, it's quite dangerous. I don't believe the world of Biden's the same as the world of Trump. I don't believe the world without vaccines is the same as today, the world with vaccines. I don't believe the world in a slightly weaker dollar environment, not necessarily a weak dollar, but a weaker dollar environment is the same as a strong dollar environment we've had for the last few years. And I don't believe a world with perhaps US 10-year at 1.5 is exactly the same as a US 10-year at 0.75. So I think the world has changed a bit, even though valuations haven't necessarily reflected that. And I think, as I said, as long-term investors, there's so much in Latin America as Ed was highlighting earlier, that it's there to be attractive. And of course, there are challenges. That's unarguable. And somebody asked, how do we think about currency? And the golden rule, really, in some of the more volatile areas, is there's something wrong with the top-down story, be that politics, be that macroeconomics, be that fixed income, then one has to be very concerned about the currency. Because in Latin America, typically, when the currency goes down 10%, the markets can fall 20% and you lose 28%, not 30%. There's a mathematical aspect there. Pretty quickly. And we've seen that in Argentina. So where we're concerned about the currency, or very concerned about the currency, where we think currencies are overvalued or not reflecting correct normality, we're unlikely to have much exposure there or to be underweight. And that's kind of one of the things that's concerned us at the margin about Argentina over recent years. So I think it's important to highlight that we are at the end of what's been a really difficult 10 years for Latin America. Things are looking up, not in a straight line basis, but we do think things are looking up. And one other question, which I'm just going to handle now before I hand back to Ed, who's going to touch on valuation, because I think that's an interesting point as raised by someone else. This is a closed-end fund, and therefore that gives us the ability to leverage up when we see some of the big sell-offs. Every single year, markets, at some point during the year, markets in Latin America sell off 30% at some point. And the worst thing one can do at that time is to panic. One needs to take a long-term view and take advantage of the opportunities that those markets throw up. So yes, this is a closed-end fund, and that's really to our advantage because it means we can leverage when we need to. Over to you, Ed, for a word on valuations.
Yeah, I just want to point out valuations. I think Latin America, as Sam pointed out, it's one of the cheapest regions in the world relative to peers. You could argue that's probably due to the political risk that we've been highlighting here. But in terms of the underperformance that the region has had versus the U.S. and other developed markets, we simply think it's overdone. And I would love to highlight the fact that on a price to book basis, every single region is trading below its historical average. And we do get a lot of periods of volatility, and that for active managers like us, that provides a lot of opportunity. When you take into context the cheap valuations that you have here on the chart, and this is as of a year end of 2020, and the fact that we are seeing a cyclical recovery in the global economy, there's higher demand for commodities. And as you see in the chart on the screen here on page 6, the region overall is highly geared towards export of commodities. You can see right there in the middle, this is the percentage of total exports, and 40% of Brazilian exports are agricultural, 35 relate to manufacturing, 12 metals, 13 oil. So a very diversified base of commodities here. The commodity chart on the top here, it just kind of highlights how commodities for so long have been pretty flat. This is also up until the middle of 2020, we've had a tremendous rebound in commodity prices as the economy's opened up, and we're starting to see bouts of inflation globally because of this raw material, reflation story takes hold. So we think, cyclically, these economies are starting to recover, driven by commodities. And I think also you can kind of see some of the estimates for GDP on the right side of the bottom half of the screen here. We are seeing a strong rebound after a sharp sell-off last year in terms of production. We really look to leverage on this in terms of what it could do for earnings revisions. We saw the earnings were written down dramatically last year, and we think that as the economies start to recover, we'll start to see these earning revisions continue to go up. We've already seen a number of positive earning revisions in a number of countries, simply because the expectations for these economies to perform last year were very, very negative, and they've surpassed, for the most part, those negative expectations. Sam, what else do we have for questions here?
Again, this is possibly a bit different to the way other people are presenting. Hopefully it makes it a bit more interesting just to listen to. It may make it sound it's slightly less connected, but I think it just makes it a bit more interesting, certainly for the end of the day. A question here about rollout of vaccines, and how we think about Latin America relative to India. Clearly India is producing lots of vaccines, and they are vaccinating their population pretty quickly. But remember, there's a large number of people. I think they're doing a couple of million people now a day. I think today was the record, or the last couple of days have been the record. But obviously there's 1.4 billion people to vaccinate. A place like Chile, which obviously has a much smaller population, I think we're expecting by the end of the first half, Ed, I think I'm right in saying, Chile is going to be done. That they've got quite a lot of the Sinovac vaccine, but it's not just about vaccination that's going to drive performance over the medium term. One has to think, and again, I'm a big fan of India or selected stocks in India. The key question, for us when it comes to investing is not just the next 3 or 6 months. It's finding long-term companies that are going to be winners over the next, not 3 or 6 months, but the next 3 or 6 years. So while it's unarguable that perhaps some of the countries in Latin America aren't vaccinating as quickly as, as, I don't know, the UAE or Israel or indeed the United Kingdom, that's not the only driver of performance in the near term. Another question we've had here is about how we think about investing in small cap stocks and how that's changing over time. Ed, do you want to start with that one?
Yeah, that's a great question. I think a couple things here. I think one, in terms of Brazil, we're finding a lot of interesting opportunities in the small cap spectrum. Just to step back, the benchmark interest rates in Brazil have gone from say 14.5% 3 to 4 years ago to around 2% now, and this is really leading to a really strong drive in access to capital markets. A really strong drive for really creative entrepreneurs to enter into the economy, and we're seeing a really deepening of the financial markets within Brazil, and this is bringing a lot of opportunities in terms of small cap investing. These are either companies that historically have strong market share in what tends to be a fragmented market or an underpenetrated market. So while the company could be a leader, say in like the hospital sector where we're invested in, they could have the leader there has 8% market share, which is big in the context of a very fragmented market, but leaves them with a lot of opportunity to consolidate the industry, gain scale, and take share. So that's one area where we're optimistic and invested in a lot of small and mid caps is the healthcare sector in Brazil. And we see a lot of additional investment and growth going there specifically. Technology is also another area that we keep our finger on the pulse there. We're seeing a lot of industries being disrupted, whether it's being the financial industry or e-commerce, as we mentioned. So we do see a strong pipeline of IPOs led by lower interest rates, which is really bringing in more capital, domestic capital, as say large institutional or pension funds within Brazil are looking to reallocate outside of fixed income and into equities, thus providing a broader capital market opportunity for some sectors which may have been underrepresented in the past.
Thank you. Another couple of questions coming here. One person, I'm trying to handle as many of these from different people as possible, and I hope this makes it a bit more interesting. One person has said, the macro is interesting, but what are your drivers of stock selection? Can you give some examples of your big bets? Now, and somebody else has asked if we're overweight a particular stock. We are absolutely going to give you some explanations of what we do, but we are not going to name individual stocks beyond what's in our presentation, because otherwise we get into all sorts of trouble from legal and compliance. So in terms of what drives stock selection, Ed, would you like to handle that? And then I'm going to take a really nasty question from one person about politics.
Yeah, so I guess it really comes down to like this 4-prong approach, and you can kind of see on the slide I have here on slide 9 of the sector allocation, and I think if you look at kind of the backdrop of some rotation into more cyclical names as the global economy starts to perform again, and coming out of the pandemic, you see well over 50% of our portfolio is in financials, materials, and energy. And we think that these will be, traditionally they've been laggards, but have a tremendous opportunity to become leaders as the cycle begins to turn. The valuations are cheap, and these sectors and stocks are under-owned. And yeah, just in terms of the investment process, I think I have a slide here. Just want to kind of go through, what we do. I think at BlackRock, there's a lot of volatility and complexity within these markets, and the people is really one of the prime assets we have here. We really look to empower our analysts and have them become experts in the fields that they invest in. We spend a lot of time looking at the macro. We think that these markets are mean reversionary, and we're looking for turning points and inflection points, and really concentrate on when our valuation's cheap, when do we think the cycle can turn, when do we see liquidity pouring in. We also spend a lot of time on the bottom-up fundamental analysis, your classic valuation metrics, and then a strong risk management component as well that is deliberate. It allows us to diversify our risk and appropriate scale our bets. So that's a little speech about how we do the stock picking.
I want to touch on one more thing, which links into two further questions. People sort of talked about boots on the ground and how we do bottom-up research. So obviously in the last year, we've been limited to the extent that we can travel, be it those of us in the US or the UK, or indeed members of our team who are based in Latin America. But absolutely, we spend a lot of time meeting the companies in normal years. We typically meet companies 5 or 6 times before we invest. We insist in meeting companies, customers, suppliers, and competitors. Typically, the competitors are much more honest about the original company than the company are themselves. So it's a lot of bottom-up research. And then people would ask, well, in the last year, what have you been able to do? And the answer is, while we can't spend as much time on the ground as we'd like to have done in the last year, the interesting thing is that company managements have been much more available. Historically, one would have to schedule things, weeks and weeks in advance to see a CEO. Now, because of sort of the Zoom phenomenon, you can grab a CEO for 20 minutes much more easily than you've done historically, be it one of the companies we invest in or one of the companies that we're sort of, speaking to find out about the other type of company. So the interesting aspect of the last few years has been the fact that, the last year and a bit, I should say, has been the fact that we've had probably a bit more corporate interaction than we've done historically. So it's a lot of bottom-up research, and it's important to highlight that we don't, we're not just limited to one type of company. Exactly as Ed was saying earlier, this is not, we invest only in this type of company. Latin America's got so much going for it. We don't think that's a particularly a sensible approach. There is one question sort of talking about dividends, which I think is interesting. So while Ed flicks to page 16, where we talk about the dividend policy, which we'll talk about, which is a fairly unique phenomenon of aspect of this fund. It's in the grey little bit at the bottom, hidden away right at the end of the presentation. It's the fact, it's the amount that we pay out every quarter. So investors are paid to wait during difficult times if developments aren't positive. So while we're sort of people are reading that, nice interesting question: will Bolsonaro leave office nicely like Trump? The words of one question. As you can see, I'm not attenuating any of these questions. Look, number one, we have to wait for a general election. Even if many people on this call may not like the style of Mr. Bolsonaro, the Brazilian population are the people that decide. This is a democracy, and in democracy, we listen to the people who live in the country, not necessarily to the media who live outside the country. So for him to leave office, he'd actually have to lose an election. He may do so when the next election comes round. But Brazil has one of the great strides Brazil has made in the last 20 years, 20, 30 years, has been relatively smooth transitions, albeit from not necessarily lovable presidents to the next not so necessarily lovable president. I think the years of the generals and the dictators are well behind us. So if Mr. Bolsonaro does lose an election, I would expect him not to like to lose an election, who does, but I would expect a smooth transfer of power. Then we've had a few questions, someone asking us to name IPOs we've invested in. Again, we're rather not going to name individual stocks. We will highlight our monthly releases where we do name our top 10, but we're just very reluctant to name stocks on an individual basis because it gives the impression that we're pushing one particular company, which is really not what we're trying to do. One has to invest on a portfolio basis. Another question that we've had here is how we think Latin America is going to perform relative to China. I think they've both got attractive features. I think the Chinese economy is doing perfectly well. I just think certain Chinese stocks are fairly expensive. So the question, I think, is probably one of sort of global rotation. I would expect that if we see a little more inflation globally, if we see a little more rotation from growth to value, as we began to see at the end of 2020, we will probably see Latin American stocks outperform China. Although, as I said, there's nothing particularly bad about either. And I think, as I said, the Chinese economy is doing perfectly well. It's just a function of style within global markets. Question for you, Ed. Can you give some idea of the degree of profitability of the companies in your portfolio, i.e. a weighted return on capital employed, or some idea of the profitability and how profitable the companies we invest in are? Over to you, Ed.
Yeah, that's a great question. So, one of the things that I look for in stocks is definitely for them to have a return on invested capital above their WACC, their weighted average cost of capital. Typically, when I look at the weighted average ROE for our portfolio, it tends to be, and sorry, I'm just looking it up here on the fly. Yeah, it's around 22.4% for our fund. And that's relative to the benchmark, which is kind of in the high teens. So we definitely put a premium on companies that have exceptional ROE characteristics. And also, we look at the underlying components of that ROE, whether it be asset turnover or profit margin, and we definitely favor the latter, those two over, say, financial leverage. I will also say, one of the other metrics I look at, and this is kind of a common tool that's used amongst software investors and technology investors, it's the rule of 40. And it's quite a simple metric, but it kind of separates companies that not only grow but can grow profitably. So what I do is I look at the sales CAGR over 3 years in percentage form, and I look at the EBITDA margin that these companies can generate. And usually, if they're able to surpass that benchmark of 40, then they tend to be higher quality growth names. And that's generally how I look to populate the portfolio. Or if it's two companies that I like in a sector, I would look for the one that grows the top line faster, but also offset with that profit margin. So we don't want companies that just grow for the sake of growing. We're mostly attracted to profitable growth.
I'm conscious of the fact that we're running out of time, and I just like us to provide a clear conclusion. I know we've done something slightly different to what other people do in handling lots of questions, which sometimes makes a slightly discordant presentation, but we think it's helpful to actually address people's questions rather than just address what we want to say. So I think, sort of in conclusion, number one, hopefully, everything that we're saying should not be viewed at all as individual investment advice. That's not what we're here to do. We're here to provide an overview of our investment trust that invests across Latin America. We want to stress the importance of long-term investing in emerging markets in general, but particularly in Latin America, given the volatility. We want to highlight the fact that we have the flexibility to leverage our fund when we see the opportunities. We want to highlight the range of opportunities in Latin America. It's not just about one country or just about one sector that happens to be in favor today. It's about a range of opportunities that help to blend, that build together to blend a portfolio that hopefully limits the degree of the volatility that is inherent in these markets. It's about a cyclical recovery. It's about long-term growth opportunities, with exposure to EVs in infrastructure and e-commerce. As was highlighted earlier, it's really quite interesting for us, where we are in the cycle, to be looking at Latin America, and we're excited to be running a trust there. So that's kind of my summary. But anything, Ed, you'd like to say in closing?
Just want to thank everyone for their time and their interest. We talk about the 4 C's, but I think it's also important on this trust to point out the 2 D's, which are dividend and discount. As of the last month end, Sam mentioned the dividend policy. It works out to be around 5% dividend yield on the trust. And while we don't manage the trust for dividend per se, we see the region as a long-term growth and we manage for capital appreciation, we think the 5% income is a nice added feature to this trust. And also, the discount to NAV, I think, is excessive and will narrow as these economies do recover. And last I checked, at the end of last month, we're trading at a 10% discount to NAV. So we see, those as two benefits to the trust and things that separate us from our competitors.
So thank you everyone for being with us. Hopefully we've run exactly to time, and hopefully it was clear, helpful, and kept people awake for the period of time. We hand back to Pascal.
Thanks, Sam, and thank you both for the approach you took to questions, which I thought made a really interesting presentation and a lot more kind of democratic than our usual approach. If any of your questions haven't been answered, please do be aware that we'll be sharing all the questions that were put to the guys after the show has ended, and they will do their best to get back to you with an answer. Meantime, thank you all in the audience for joining us today. I hope you've got time to drop in tomorrow when we'll be hearing from fund managers running specialist funds across a range of strategies. And thank you, Ed and Sam, for taking your time to talk to us and for a really great presentation. Thanks.